Good day, trader. Welcome to our video on the talk show. Actually, what happened is that when we have the meeting, the talk show, I was unable to screen record. I didn't record it. It was after the meeting I was like, what? I did not record the whole stuff. So I just have to make a video to explain and like do a explanation just to explain everything that I talked in that talk show again. So it's really saddening, and I didn't even know that I am not recording the whole stuff. Okay, so for the talk show, our topic is blending strategy, combining structures, liquidity, and entry model. So we are combining both the structure, which is the market structures, liquidity, and entry model. I said a lot of things in the talk show, actually. So for people that are there, it is an addition to them, right? Okay. One thing I said was that for the first thing you want to do when you want to take a trade or when you open your chart, first thing you do is look for a confirmation, not an entry. Confirmation, not an entry. If you look at the three things we are combining together: market structure, liquidity, and entry model. Entry model is the least of them, which means that market structure and liquidity is the confirmation. When you open the chart, before you even look for where can I enter the trade, you should be asking yourself question like, where is market going to? Where is market going to? And what is the trend of the market currently? Because most time, what we all retail trader does is that we trade against the trend. And yes, sometimes we can have a little profit, but on the long run, are we having that profit? Because we need to trade at a very comfortable zones so that we can move along with the market. We can move along with the market makers. So that is one of the things we are doing today in this video. And I'm very sorry for not to be able to record the whole stuff, the questions and everything that happened yesterday. So I just wish that this whole video will be able to explain everything. Okay, this is it here. Market structures. Let me put a view. Okay, I hope everyone can see it like this. Okay, let me try to. Okay, market structure. This was Kisma Talk Show episode 3. So the first thing is that we are combining the structures, the liquidity, and the entry model into one trading framework. So that is just our assignment for today. So first thing is market structure. And market structure is the foundation. Is the foundation because market structure tells you what is market currently doing in the market, what is the trend of the market, and what is market currently doing, and okay, it gives you where in the market. It answers the question where, because market structure has the ability to show you the bias of the market, to show you the draw on liquidity and the direction. Market structure is able to tell you the direction of the market, and market structure is able to tell you where market is going next. That is the importance of market structures. So market structure is actually the key in the market. It shows you, like from here now I said market structure tells the story of the price, tells the story of price. So before you even take a trade, you need to understand, you need to be able to give and you need to have an understanding of the story of the market. The story of the market is okay. Before you take a trade, can you even tell us a story of why you want to take the trade? So market structure, if you understand and have this foundation, you'll be able to go in a long way. Because if you understand market structures, then I think you have solved at least 50% of technical analysis. Don't forget, forex trading is 20% strategy, 80% psychology. And that is why our episode 1, episode 2 is talking about the psychology part, and we'll still be talking about the psychology part because a lot of traders don't focus on the bigger probability or the bigger percentage. They said forex trading is 80% psychology, 20% strategy, and you see a lot of traders focusing on the 20%, not the 80%. So as we traders in this community was smart FS, we focus more on the 80%. Yes, we need to have a good 20%. You need to have a good strategy, but 80% you cannot neglect it. Okay, and also you need to know that in trading in the forex market, there are two ways you can analyze the chart, or there are two ways you can know where market wants to go to. Number one is fundamental, and number two is technical analysis. They are both analysis, but one is fundamental and one is technical. But in this video and in this talk show, we are only focusing on the technical analysis. So I just want you to know that there are two ways. So the technical analysis, and in technical analysis, don't forget how we are dropping it down. In technical analysis, if you understand market structures, you have already understand the 50% of technical analysis. Do you understand? So market structure is the foundation. So I said there are two things you need to know in market structures. Actually, they are advanced in market structure, but I just want to tell you that there are two things you need to know in market structure. Number one is short time low, short time high, intermediate time high, intermediate time. Those are the two major things, and you need to know where market breaks the structures, or when there is a change of character, or something I call the market structure shift. So you need to understand when this one is a break or it is a change of character. So those are the three things you need to know. So if you even understand short time high, short time low, intermediate time high, intermediate time low, you are good to go. Good to go. I'm very serious about it. Okay, it gives you where in the market. The next one, we have liquidity. Liquidity is the hidden fuel, in the market, because market don't just moves. ICT said something. They said market draws to two things, and which I have studied so far, and it's true. Market draws to two things. Number one is liquidity. Number two is fair value. So those are the two things market draw to. So our job as a trader is to understand that, okay, where is the liquidity in the market? The moment you take a trade and you are unable to know the liquidity in the market, it means that you are the liquidity in the market. You already be among the liquidity. Any trader that take a trade without knowing where the liquidity is in the market is an uninformed trader. So, and we don't want to be an uninformed trader. We want to be an informed. Then it is our responsibility as a trader to understand first where the liquidity is in the market, or what is market currently doing. So he said the liquidity is where smart money owns. And retail traders look for support and resistance. Institutions look for liquidity pools. Retail traders, they look for support and resistance. And most time when you see me trading, I don't usually trade support and resistance, even though they are the basics in the forex market, because you can't do without trading in the support and resistance. But you don't see me trading. I only trade them as a confirmation. I trade them as just what is retail trader doing. So retail trader look for support and resistance. They look for both equal highs, equal lows, or those stuffs. But institutions, they look for liquid. They look for where market has, where there is a liquidity, high liquidity, and they go there to run it out. That is what they do. So you need to understand that. The second thing we look for is liquidity. Liquidity gives you the why price move to a certain zone before reacting. Why is price going to this place before reacting? So if you understand market structure, the next thing you need to understand is liquidity. Why? Why is market going to this particular place? Why is market reacting? Have you never asked yourself as a trader and you look into your chart and you begin to ask yourself multiple questions like, why is market going to this place? I want to tell you today, and as a little year I've used in this forex market, that's 4 years plus. I want to tell you that there are just focus on the market structure and liquidity. Where is market going to? Don't all every other thing share it out. Like there are noises. You need to understand where market is going to. Liquidity gives you why. Why? Liquidity gives you why. And the next one is entry model. So the entry model, that is precision triggered. This is where you define how to enter. So after you know where, you know how, you know where, and you know why. After you know the where, you know the why, then now the next thing is how. Because when you have the confirmation, the next thing is just the entry. So don't forget, if you don't take anything out of this talk show, one thing I want you to remember always is when you open your chart, look for confirmation, not an entry. Look for confirmation, not an entry. Market is not going anywhere. It will still be here, still be here. So looking for confirmation, not an entry, will develop patience in you. And that is one of the virtues that forex trading require forex trading require from every trader, patience. Okay. So this year entry model will not be talking much on it because we need to do that on the charts. So combining the structures, liquidity, your entries become clean, efficient, and repeatable. Because when you do it, it will become repeatable. If you can combine these three things together, then it's something you can repeat and repeat and repeat and repeat. So blending it all together, now you are not reacting. You are executing a complete strategy with logic, precision, and consistency. I can say something with clarity, precision, and consistency. Because that consistency is very, very important in the forex market. It's very, 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 very important. So my final thought here is mastering one concept can give you an edge, but blending structures, liquidity, and entries create a trading system that is not only repeatable but also scalable. Can scale it. So execution without understanding leads to failure. Understanding creates freedom. Understanding creates freedom. So let's go into the chart and see what the markets are for us. Okay, the first thing I said is market structures, and one of the ways I said something about market structure is that short time high, short time low, intermediate time high, intermediate time. Those are the market structure edge, or those are the things that are important when it comes to market structure. And don't forget, this is a short time high. A short time high, we're having something like this. Market trading from a fair value gap, then creating a new fair value gap. So which means that market create a fair value gap, market trade away from a fair value gap and instantly create a new fair value gap. So this is what here we call a short time high. A short time high must trade from a fair value gap and create a new fair value gap. That is a solid. I'm not talking about because it's a short time high, like any short, any any. No, no, no. There is a principle for short time high, and reverse of it is short time low. So which means that this particular this low here trade away from a fair value gap and create a new fair value gap instantly. This low is very, very strong, which means that if market want to buy, market should not come to this low. That is a solid short time low, and this is a solid short time high. Yes, if market want to buy, market should not take it out. And let's see intermediate. So we are talking about intermediate. We have a lower high, then a lower low, then a lower high. Now this low here was unable to take out this low, then it breaks this high. So the moment market breaks this high, it gives us what? It gives us a MSS or change of character. So which means that this particular low here becomes what? Becomes an intermediate time low. Why? Because we have a lower high and a lower high at the left and the right of it. And market breaks this high. what will make it very, very good or solidify, which is not, it is not part of the principle of intermediate time high, but I'm just saying it, is that if this low here is a short time low, and you know what a short time low is, which means that there must be a fair value gap here, and it will create a new fair value gap. That's a short time low. You understand? So let's come. Okay, so this is a intermediate time low. So I hope everybody understands what intermediate time low is. And if you have been following me for a long time, this should not be something we'll be discussing right now. But you need to take your forex trading very serious. Just take it serious, like study the way you study in school, and that's it. So opposite of it is intermediate time high. So we have a lower high, a higher high, and a lower high. So that's it. So this is intermediate time high. So now we understand the part of market structures, that short time low, short time high. It tells us the intention of the market. It tells us, are we bullish, or we are bearish. It tells us the intention of the market. It tells us the trend of the market. And intermediate time lows, intermediate time high, they are the outsiders of the market. They are the outsiders, which means that if market want to be bullish, market should not break intermediate time high, intermediate time low. If market want to be bullish, that's it, 100%. And you need to study it yourself and see in the market. This is daily chart here, and don't forget what you are discussing. Those are the market structures and the liquidity and also the entry patterns. So there's a recent trade I took on Friday in my Telegram channel. So I want to use this, what we are talking today, the blending strategy. I want to use it to explain that trade, because I still the same thing I use. I use the same models to just take the trade, and everybody took the trade, everybody was happy, but they need to understand why we take this trade. Sure, you understand? So I want to use the same, this what I just explained, to tell you how I took the trade. Okay, the first thing we need to do when we open the chart is look for the trend of the market. Look for what is the market structure, what is the bias. Are we bullish? Are we bearish? So now, looking at this whole chart, this daily chart, if I take everything out and look at it, I zoom in or I zoom out and I look at it this way, what I will say is that, oh, we are bullish, because okay, because what, market creates an short time market create a what, a short time high, a short time low. Market trade from a fair value gap and create a new fair value gap. So here we have what, we have a short time low. So a short time low means that market is bullish, right? So, and if you look at it, market has not breaks any short time low. So which means the next place market can go to is this. If I zoom out, like if I zoom out now and show you the whole structures, that's what I call the external. And if you look to this left side too, you will see that we have an intermediate time low being created. We have a low here. This is a low here. You can see this swing low, and we have a low here. So a lower high and a lower high, and in the middle we have a lower low. So which means that market was unable to take this low. Market was unable to take that low. So which means this particular low here is what? Is an intermediate time low. And they are the outsiders of the market. So which means that market wants to continue bullish as long as market has not come to break the intermediate time low. And you can see it here that the moment market breaks this high, the moment market break this particular high, you can see that it creates a fair value gap that market trade off from and become bullish. So this is a daily chart. Like I'm just explaining on the daily chart, you can know the uh before market form all this, you know how many days it takes, and you can see the profitability you're going to see on the daily chart. But one thing I just want you to know is that daily chart is where, if you're an intraday trader, a day trader, focus more on the daily chart. Focus more on the daily chart before you focus on any 5 minutes or anything. Focus more, understand the daily chart first before you go down to any time frame. So this, you can see an intermediate time low, you can see a short time low, so which means that market has not created anything opposite it, no intermediate or anything. So you can see that now we are bullish. Externally we are bullish, but now if I zoomed into this place, you can see that here also we are having a short time low, because it creates a new fair value gap. You can see that the moment market create a short time low, market did not come to a short time low. It continued its bullish without taking a short time low. So which tells you that short time low, short time high, intermediate time low, intermediate time high, they are the components of market structures. They are the one that tells you the trend of the market. If you want to look for the trend of the market, first look for these two things. If you can see these two things in the market, then it shows you the intentions of the market. It shows you the trend of the market, instead of just looking at, oh, market is bullish because of this, or because of bearish candle, market is bearish. Now the moment market begins, here market disrespect this fair value gap here for bullish continuation. Market disrespect it, and market take out a what did I call this, a short time low. Market take out a short time low, but you can see something here that market breaks this low and create a fair value gap for bearish. But the moment market enter a fair value gap for bearish and break this low, market did not create a new fair value gap. Can you see that? Market did not create a new fair value gap. So which means that even when market was trying to retrace as a bearish, it was trying to do an internal bearishness, market did not create a short time low, a short time high, intermediate time low, intermediate time high, intermediate time low. Like market did not create an intermediate time high, or market did not create a short time high. I just want you to understand these things, that it is a way to understand. Okay, now if I look at the chart from here, and the way market did not create a short time high, I will just be like, oh, market is not bearish yet, because I have this understanding that, oh, market did not create a short time high in the market. So here, no bearish. So now we have this market come back here to break. You can see that market come back to break it, because it is not a solid short time high. Why? It traded from a fair value gap, but it did not create a new fair value gap. And you need to understand that. So the main market break these structures and create a fair value gap here. So I was like, fine. Now let's see a possible buy. Don't forget, externally we are bullish, but internally market create a bearish moves, which can possibly be that market want to take a liquidity here, and that's just all market want to do. So but because we can't control the market, it is only the market makers or the banks, the hedge funds, that can do that. So our job is to control ourselves. Anything you can't control is outside of your power. Anything that is outside of your power, you can't control. Then why focusing on the things you can't control when you can just control yourself? Now, because I am bullish externally, does not mean that I should be looking for buy any opportunity there. I have to wait for the right moment for me to buy. And you can I entered a buy here, I entered a buy here, I entered a buy, even even here I entered a buy. That's based on my strategy, and I dropped the entry on the channel. But now let's continue. So the way market built the structure, I was looking for this fair value gap for buy continuation. But when we go down to, so the first thing we need to know is that here on the daily chart, market structures is bullish externally, and internally market have a change of character. Market breaks a high, so which means that market want to change and it creates a fair value gap. So we are expecting market will enter the fair value gap and buy. So where can market go to if market trade away from this fair value gap? We have this I. So this I here is our draw on liquidity. So don't forget how we do it, how we did it. We look for the structures and we look for the liquidity on what higher time frames. That is very, very crucial. The draw on liquidity and the structure. What is the structures on higher time frame? That's the first thing. Okay, so you can see that we have already get our draw on liquidity. We also know the structures on what from the higher time frame, and that's the first thing we need to do. That's the first thing we need to know. So now the next thing is we know though I have done all this work on daily chart, that does not mean that I'll go down to lower time frame and begin to look for buy and everything. I still need to look for confirmation. I still need to know the market structures of the time frame below the daily, which is 4 hours. So I need to have the understanding of the structure of 4 hours chart, and if need be 1 hour chart before I take any trade on 15 minutes. So which means that if daily says buy, if daily market structure or the daily trend is bullish, 4 hours must be bullish, 1 hour must be bullish. They must align together. 3 time frames must align together before you take a trade on 15 minutes. You can't have a daily chart is bullish, then 4 hours is saying bearish, and you now take a trade of buy. On the long run, you may it take profits, like if you put a larger stop loss, because 4 hours will actually display himself before doing anything buy. So you need to wait for 4 hours, 1 hour, and daily to align. Let all three of them to be bullish before you target this liquidity zone. So let's go down to 4 hours chart. Okay, this is 4 hours chart. You can see this is the fair value gap we are looking for buy, and this is the draw on liquidity. So I want to show you a very, very important lesson. Don't forget, when we look at the daily charts, when market breaks this high, we are like, oh, market is bullish, right? Now on 4 hours chart, you can see that market is what? Market is bearish. Why? Market creates a short time. Market creates what? A short time high, and also market creates an intermediate time high. How? You can see how very funny market is. See it here. This high here is what? Intermediate time high. A a um a higher low, at the left, and also a higher low at the right, and this is a higher high. You can see it here, a higher high, and when the market breaks this low, we have a fair value gap and market trade from the fair value gap and back sell. So again, market break the structure. Also, we have a fair value gap here. So you can see that market did not go to this high. Okay, market comes to this high. This is a short time high. Just take out liquidity, took out the liquidity, and just a little bit down. Market only took out the liquidity at that short time high. So which shows that the sell is not actually a bearish market, is actually not in a bearish scenarios. Market is just selling for retracement. Market took out the liquidity, then sell. Then here market break this low again. We have a fair value gap here, which market did not enter until this place. Now I actually understood why market comes down to this place, because there's a fair value area here. Don't forget, on 4 hours chart too, on 4 hours chart we have intermediate time low. This intermediate time low here, you can see it here, a lower high and a lower high, so which means we have a lower low. So we have intermediate, and this intermediate time low here, this low here traded away from a fair value gap and create a new fair value gap. So which means that it is what? It is a short time low, a confirmed short time low, and that is why when market was coming down back, market did not take the low, because it is a short time low. If market want to be buy, if market want to be bullish, market should not take a short time low or a short time high. short time low if market wants to be bullish, short time high if market wants to be bearish, and market should not take an intermediate time low if market wants to be bullish. So you can see an example here. So the moment market, so all this sell that we have here is just a retracement into the fair value area. So the moment market get to the fair value area, then if bearish fair value gap for bearish continuation, market disrespect it, and the moment market disrespect a bearish fair value gap, it turns to what? It turns to IFVG. It is called a reversible fair value gap. Yeah. So it is a reversing fair value gap, or something we call inversion. Inversion fair value gap, IFVG. So which means that that is what this guy turns to. A bearish fair value gap disrespected turns to what? A bullish fair value gap. And even without that, even without this, market creates a new fair value gap here. So there's also a bullish fair value gap at that particular level, which I actually shows in my actually showed it in my Telegram channel. I want to show you. Okay, I don't know what is happening with my network. Okay. So I just want you guys to know that this is not just, you can see the fair value gap I'm looking at for. You can see I'm looking out for buy because what market trade away from here. Now, the moment market disrespect this fair value gap and enter this fair value gap, it shows that 4 hours chart is what is bullish. So my daily is bullish, my 4 hours too is bullish. Don't forget, we don't be a buyer in this retracement. We wait for 4 hours to turn bullish. Then let's go to 1 hour chart to see if 1 hour support everything we are doing. Yes, 1 hour to supported it because even from here, 1 hour has become bullish, and you can see. So which means that from this green, from this fair value gap to this place, that is where I'm looking for what? I'm looking for my buy. I'm looking for my buy inside that place. So you can see how we were able to put everything down by just looking at the market structure and where is the liquidity. So these two things will give us what? Will give us the context. So this is a context. So which means from year to year, if I go down to the lower time to look for my entry pattern, I will be a buyer so effortlessly. So effortlessly. And so now on the lower time frame, what you are looking out for, you are looking out for intermediate time low. So when I see an intermediate time low on the lower time frame, then I will be a buyer. So the first intermediate time low I saw was this fair value gap here. So you can see it here on the 4 hours fair value gap. You can see 15 minutes, this 15 minutes, right? So this is a lower low, a lower, yes, we're having a lower high, and we're also having a lower high. This low here was unable to take out this low, so which means that this give us what? Intermediate time low. So the moment market breaks this here, so we have a fair value gap here. So and that gives us a buy entry, stop loss below this low here, and our take profit to where our draw on liquidity. You can see that market did not come back to the intermediate time low. It's just going by. So during the New York Q zone, I also saw another intermediate time low. Don't forget, this is the context. I'm looking for buy in this green zone. So on this place too, I have a lower high here and also a lower high here, and this middle one here is the lower low. So this is it here. The moment market breaks this high, my fair value gap is here, or the one I use is actually this one. So you can see it here. So market create another intermediate time low, and that is where I put my entry, and that's the one I gave to the Telegram channel. So you can see how we're able to put down everything. Now look at the liquidity zone. The moment market get to that liquidity zone, you can see how market just reverse. It shows that we are able to identify the real liquidity, and that is the way to take the trade. Now let me show you on my Telegram channel. Okay, so you can see this is the trade here. You can see the trade, and you can see how I entered, showing everything on the chart, and you can also see where market is the take profit. You can see where the liquidity is. You can see how everything. That is the way to take the trade. First thing, your market structure. You need to understand it first before you take any trade. Number two thing is, where is market going to? And the third is, how can we get there? So thank you so much for joining, and thank you so much for watching this video. Don't forget to like, share, and subscribe. Thank you. I love you guys. Thank you so much.